I'm Charlotte McLeod with investingnews.com, and here today with me is Joe Cavatoni, Senior Market Strategist Americas at the World Gold Council. Thank you so much for being here. Always great to have you.
Thanks for having me, Charlotte. I always enjoy coming back and talking to you about the gold market.
Yes, and certainly there's a lot going on. The World Gold Council has just released its latest demand trends report, so we'll get into all the details there. But before we do, I thought we should do a little bit of a check-in on what's happening with the price. We last spoke a couple of months ago, right when the Iran war was just beginning, so we hadn't had a chance to see yet how the gold market might be impacted. Has the price activity we've seen for those last couple of months made sense to you? How are you seeing it?
It's a great question and probably the most important place for us to start for sure. So I think the first quarter and as we move into April, what we've seen with the price has been probably what we haven't normally expected from the gold market, but not unexpected for the conditions that we're dealing with. If I could go back even before the conflict with Iran and the US, go to January, I think the political, geopolitical, and rhetoric coming out of the White House and the administration is probably aggressive as we've seen it. And quite honestly, that led to a very high level of the price and the subsequent pullbacks that we've had. Now, I think as we've moved into the conflict and actually where we are today, and I think the price as we record this is trading around the 4,500 level, 4,600 level, and that's up a 6% level for the year. Not abnormal. But what's interesting about it is it's actually looking and pricing in a lot of the conditions that are potentially coming as a consequence of this conflict in the Middle East persisting. If you have a long, drawn-out conflict in the Middle East, and that impacts the price of oil, the markets are definitely pricing an inflationary condition that will persist not only in the U.S., but on a global scale. Because oil is important to fuel emerging markets, it's so important to fuel economies around the globe, and actually the dependency on the Middle East oil is being completely curtailed. That's what's actually giving us a bit of a headwind. But what I like about what we're seeing with the gold market is even with that pretty pronounced risk and condition of inflation giving opportunity cost away from gold, is the fact that we're still holding quite firmly at high levels, 6% up for the year, 4,500, 4,600 on the price. These are good signals for us that tell us strategically the longer term trajectory for gold makes sense for us and that all we've been looking at will continue over the next 24 to 36 months.
Well, and since you mentioned it looks like we're heading toward an inflationary environment, can you talk a little bit about how gold tends to perform under those circumstances? I think we hear a lot about gold being a hedge against inflation, but how does it actually usually play out?
It usually plays out that the initial implications of inflation are headwinds for gold. So when we look at it, actually, it's probably best to say that inflation in its own right isn't what we need to watch. What I think we need to understand is how monetary policy responds to it. And actually, we're getting a great signal for that this week alone. And I think you want to talk a little bit about what the Fed's up to, but just kind of characterizing it, you've got the European Central Bank, UK, Japan, the US, either holding or raising rates to curtail the risk of inflation. So that actually creates an environment where real rates and the environment for bonds may be more appealing to people. And that gives us a little bit of competition or headwinds when people are looking at what they want to have in their portfolio. Again, what I think is really quite interesting is that we have a good, solid performance of gold, even with these conditions developing. But over time, as inflation gets managed, then you'll start to see gold holding its value. But on the shorter term, you should expect this to be a headwind. And I think that we need to see inflation managed down before the Fed and other central banks may come back to the market to look for a rate cut. The Fed's actually talking now about no move in rates. There's even been discussions around the potential for an increase in rates. I don't necessarily see that coming. But if you look at market predictors, you're looking at a December date in terms of the earliest timeline for a Fed cut. So a long way to go. But I think it all hinges on what develops with the Middle East because this condition of inflation is being exacerbated by the oil price.
Okay, I think that helps me understand how you're thinking about it right now. And you're right. I do want to talk a little bit more about what's going on at the Fed, just because we did have the latest meeting today. So we saw interest rates stay steady, as I think was very widely expected. But there's this transition that looks like it's now playing out between Powell and moving over to Warsh. It looks like some obstacles have been cleared there. So anything you would add on that transition, what we might see from Warsh? What I was seeing about this Fed meeting, I haven't had a chance to look too deeply at the commentary, but it does sound like that dissent at the Fed does persist.
Yes, it does. But he is making sure, or I should say, is making sure that it's an organizational think. It's not a Warsh think only. So I think it's a really interesting time, and I think it'll be fun to see how this develops. I think one of the biggest risks that we were all talking to and facing was whether or not there would be independence to the Fed, or if the administration would have a heavy hand and actually influence its behavior. I get a good sense, and I think the market does as well, that Warsh will keep that independence and it'll actually look to do its job the right way. But I think they're looking at the balance sheet. I think they're actually looking at keeping that, paring it down. I think they're also looking at the right moves with respect to rates. I think that things look like we will get a continued type of performance from the Fed that we've had, which is a group think where there needs to be consensus on what to do, and actually the right kind of activity, not influenced by political powers. But again, I think the big message right now is this inflationary condition is one that's going to basically put us on hold for a rate cut. And again, that rate cut kind of environment is where you're going to see gold do really well. This right now is a market for people considering what should I be thinking of when it comes to the bond market, and how should I be positioning around those assets on the shorter term.
Certainly, I think that's true as well. And for you, I wonder, did these circumstances that we're heading toward, does that point us toward a recession? I know it's a big question that people have. They wonder why we haven't seen one yet, if it could be coming. How do you see this playing out?
When I think about the question of we heading to a recession, I sit in the U.S. I think about it from a U.S. perspective. It's not hard, or I should say it's not easy to see us heading into a full-blown recession, but it's hard to judge. But I also think more globally, we are an asset that's consumed on a global scale. And one of the things that continues to stay on my radar is what really will this all mean for emerging markets? And I think that I would watch inflation conditions globally. I'd watch concerns around consumer behavior, concerns around savings, investment flows, central bank flows on a global scale. Because while I think the U.S. market is substantial and major in terms of its influence, the gold market's going to be equally influenced outside the U.S. borders over the next 6 to 12 months. So probably not a quick move to a recessionary environment. Maybe we see stagflation, but right now I think I'm keeping a closer watch on these immediate conditions that might lead to emerging market changes and changes to central bank flows as well.
Great points. I think you're always good at helping us remember this is a global market and not to get too focused on the US. Maybe we take a look at the demand trends reports, and starting with central banks, which you were just mentioning. I know since the start of the Iran war began, there have been headlines about central banks selling gold. So I was curious if you could weigh in on that and also tell us what central bank demand actually ended up looking like for the first quarter.
Yeah, it's really interesting color for sure. Actually, what we saw for the first quarter was a net positive gain of 244 tons, which I think the headlines for you are right. Were all about those central banks that were making moves to make utilization of their gold. And actually, that for me is actually a very interesting thing for people to digest. Understand that we've talked about reserves adding gold to portfolios. Central banks are using it as this liquid instrument that they need. And, we talked about what's going on with the price. Lots of people have made significant gains on gold. Profits were taken, utilization of gold to get to cash. When you're in the conflict environment, the post-conflict environment, you're looking at people looking at that. Central banks are right in the mix of that. So you did have a lot of headlines around Turkey, Ghana, Tanzania, some others that were actually selling as well, SOFAS, Russia. So you have all that noise, but net, what we saw in the end over first quarter was a net purchase of about, 244 tons, which is actually encouraging, putting us back in line with those numbers we've been seeing for the last 3 years, 22, 3, 4, now into 25 and 6. That near 1,000 or over 1,000 tons. I think last year in 25 we were somewhere closer to about the 860 level. But again, these are very substantial levels, and these levels continue to be, top of mind. So you're seeing Russia, I should say, you're seeing Poland, you're seeing China, you're seeing other central banks that are continuing to be at the table, purchasing and adding to their reserves. So a dynamic book of business, and overall, a lot of activity in the space. We might see some IMF reporting that comes in. We might see some resetting of some of these numbers. But I think right now the interesting thing is that we're actually still in net purchasing territory for central banks, even with those making use of it.
Yes, this is a really interesting point to look at. And I wonder, is there anything you can say further about central bank demand in 2026? It sounds like essentially gold is doing its job for various of these countries. And if we keep seeing the Iran war persist, these conditions, maybe we see a similar mix as to what we've been seeing, or how do you see it?
I think it's a wonderful illustration for people to get their head around, to say, if you hear about people putting reserve assets to work, this is a great demonstration of that. We even had a situation where the Banque de Paris, the French central bank, actually moved their gold from New York from the Fed holdings to back home. They upgraded the gold from Fed melt gold to LBMA good delivery, and actually did a sample trade there to give themselves a mark to market on the portfolio, which I think was really quite an interesting dynamic. So you actually see an engaged central bank community utilizing the gold, and actually I think it really gives us a strong sense of confidence, and I'm eagerly awaiting what the survey results that we have on an annual basis will let us know about what the sentiment around gold is. In the past we've heard a concern with being too dependent on fiat currencies and a desire to move away from that over the next 5 years. I suspect we'll see that as, again, a big signal that we'll get from the central banking community. We're also seeing the level of holdings increase to about 25% in terms of overall reserves on average. So, you've got a lot of interesting things that could develop. But right now, all very good.
Yes. I know we have to wait for that central bank survey, so that will be very interesting to look at when it comes out. If we take a step back and look at overall gold demand for Q1, I believe the value hit a new record. And I was wondering, is that more a function of the higher gold price, or is it a combination of that plus higher demand? How does that shake out?
Well, look, I think we were a little bit higher in terms of quarter to quarter comparison, Q1 to Q1 of 25 to 26. And actually the price is clearly weighing in. But look, you've got a 2% level in terms of a tonnage up for the quarter. And with the higher prices, you're definitely hitting a much higher value that's being put to work in the market. But it tells us two things, really simple. Lots of interest continues to persist, and the price is being tolerated by people that are still very much engaged in the market.
Yeah, I think that's a good, simple way to break it down. I want to take a look over at bar and coin demand and the ETF demand. So bar and coin demand, it looks like was really strong, driven by Asia largely. ETF demand maybe fell off a little bit. Can you break down the highlights from those segments?
Yeah, I think you nailed it with bar and coin demand. I think that overall there was a lot of interest on the part of the Indian market, the Chinese market, and I think that the numbers are kind of mixed in terms of what we're seeing in terms of the different flows. My sentiment in terms of bar and coin demand is that it's actually continuing to be a substantial market around the world, particularly in the emerging markets. Some interesting color in terms of the overall demand profile in the US. We saw a bit of a move away from more to bars as opposed to coins, which they think is a little bit of an interesting dynamic and a shift. But it continues to be a pretty substantial component of the market. It's a 474 ton gain over the quarter, and actually that is about just about a third of the overall demand that we've had for the quarter. So substantial, and I think that that's pretty exciting news. The other thing I'd say on the ETF front, this is actually where it's been very interesting to kind of gauge the sentiment of Western investor versus Eastern investor. And first quarter showed a little bit of a some interesting flavors there. You had a North American market which had relatively a flat to down quarter, in particular in the U.S. A lot of that concentrated in instruments that are a little bit more oriented towards trading and expressing shorter term views, while the Asian markets added about 84 tons of gold and actually are probably on track to hit a record again this year. I know it's very early to call a record flow, but overall, the market is actually up, strong, and actually well advanced in the Asian markets and actually leading the charge right now. So that's kind of the breakdown. Europe has been a little bit less active than we'd expect. And I know we're talking about first quarter numbers, but if we look forward into April, you'll see that the European market's coming back online. So I think the momentum trading and a bit more of the tactical trading in the Western markets is kind of showing itself in the ETF flows. Whereas in the Asian markets, you have a little bit less of the jewelry demand, but you have definite uptake on the investment demand, in particular amongst the financial instruments.
It's always interesting to see how those different mindsets end up showing themselves in the results. And since you mentioned jewelry, I think we should take a look at that as well. I know lately the higher prices have placed it under some pressure, but we are coming into a time of lower prices. So how did it shape up in Q1, and could the lower price environment potentially bring some improvement for jewelry demand?
The simple way for people to understand what's happening in the jewelry market: more money is being put to work, but it's resulting in less tonnage being consumed. So I think that's probably the very interesting fact to understand. So less jewelry is being purchased in terms of the tonnage, but the prices that are being paid for it are higher and leading to a higher purchase value. So more money, less tonnage, so definite interest. But I think a couple of additional elements that are playing out in the jewelry market. We're hearing more anecdotally about jewelry being exchanged, upgraded. So maybe your old piece is being exchanged for a new piece. So that's actually something that doesn't show up in new demand, but actually gives us a signal that the jewelry market still is sticky for the gold environment, and actually consumers, again, the decline on the total in terms of the tonnage, still at the market and actually having, reasonable amounts of money being put to work.
Well, and does that show itself in recycling supply? Because I remember from past conversations, higher prices tend to lead to more recycling. So how's that looking?
Well, recycling is up, but I'd argue that the 5% increase we've seen in recycling as a total component of the supply side isn't enough to tell me that the consumer in the emerging market is feeling the need to liquidate their overall level of jewelry or holdings. And again, this kind of circles back to that conversation earlier we were having about what's going to play out for the emerging markets. Remember, jewelry in India, China, very substantial markets. Asia, still a very big market, and actually often put to work, whether it's through the recycling market or the secondary sale market. So keep a watch on that. If you see that recycling number higher increasing in terms of overall level of activity, then you're going to basically see that there might be some stress in the economy. People are needing money and looking to the gold market to generate the cash.
That makes sense. So that can help us get an indication of what's going on. I'll bring up tech demand as well. I know you also always usually like to touch on what's going on there. Anything special to note? I know it tends to be kind of a steadier part of the picture.
Yes, I think simply put, it's our little corner of the market where AI is actually having a direct impact on the gold market. I think that the infrastructure build out is attracting industrial use for gold. So it's actually a good thing to see that the number is not waning. But again, small enough that it isn't necessarily meaningful in terms of its overall impact on the price. But with the AI infrastructure build, it's actually a price in a market that can sustain continued growth at 4,500 or higher.
Makes a lot of sense. And we can start to wrap it up, but I'll ask you before I let you go, any final points you would leave investors with either on the report or on what we should be watching right now? It sounds like the geopolitical angle should probably remain front and center for us moving forward, at least in the near term.
I think the geopolitical angle will. I think that things that we would point to and highlight in our outlook, we've talked a little bit about volatility for gold being higher than it may have been in the past. I think that as we have a little bit of a calming around some of the geopolitical signals. We might see that vol level and spreads on gold come down and tighten up a little bit. But don't be surprised if you see that come back into play when noise gets back into the system. We just have to wait for that next catalyst. So I suspect we'll continue to have a volatile, met with flatlining kind of price environment for some time now. I think the biggest thing to keep close watch on is, again, that economic condition that develops over the next, let's call it 6 to 12 months, really something that develops as a consequence of the outcome of this war. It's hard for us to put a signal on exactly how this is going to come to a close, but I think it's going to be vital for us to see what it means. We're all looking at $6 at the oil pump, and actually in Asia that's even higher, or emerging markets, I should say, even higher. And it's actually quite concerning. So I'm watching two things, watching for the increased vol that continues to persist, even though it might look like it's calmer today. It's still lurking there. And I also think that I'm watching the big signals around the central banks on a global scale. Like, when are they going to be needing to respond to conditions that are being impacted by, this inflationary creep back into the system?
All right. Well, we will keep those on our list as well to watch, and I'm sure we'll have you back in the near future so we can go over what continues to happen. Thank you so much for coming on to talk about what's happening with gold and, of course, with the report. This was great.
Thanks so much, Charlotte. Always great to be here.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Joe Cavatoni with the World Gold Council.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.